Okay, in this video, I want to do 4.12, the BOP, the Swiss Balance of Payments. So I'll just describe the overall structure, and then we'll look at the data just to remember essentially what are the key things that we should keep in mind. Right, the first thing, this is how you should start your presentation of the BOP. To just say that Switzerland, like most countries, if not all, are open economies. An open economy is one that trades with the rest of the world, okay? So it exports and it imports. Could be goods, services, resources, or assets. These are the four main things that you can trade internationally. So there are outflows and inflows of goods, services, resources, and assets. And basically, whenever we talk about an international transaction, we are referring to an economic transaction between two residents of two different countries. A resident, you are a resident of the country in which you live. A resident could be an individual, but it can also be a company, or it could also be a government. Okay, so basically, all the what we call the economic residents in Switzerland are all the people, companies, and governments inside Switzerland, basically. And so there are so many international transactions between two parties, two economic agents that are residents of two different countries. And the balance of payments is an accounting document that records all of these international transactions over a given period of time, usually 1 year. Okay, that's how you start. Start by defining the balance of payment. And the balance of payments is organized in different accounts, and that's basically, I'll just summarize I'll just draw the big thing. The balance of payments is organized in three main accounts. Why do we have three main accounts? Because we are going to record different inflows and outflows in different accounts. The first one is the current account. Second one is the capital account. Third one is the financial account. So three main accounts. There are no definition, there are no individual definitions for each of these accounts, the different flows are recorded inside different accounts. That's it. So what do we have in the current account? Well, first we have what we call trade in goods. The balance of trade in goods. So this is when we're gonna record the exports and the imports of goods, okay, so tangible items. So the exports will be receipts, because when we export, we receive money, and the imports are going to be expenses, because we spend money. We also have trade in services. So that's exactly the same thing, but instead of recording imports and exports of goods, we record imports and exports of services. A few examples of the services that can be traded internationally: tourism, could be transportation, could be consulting, stuff like that. I think these three are probably the most important one: tourism, transportation, consulting. And maybe a few words about that. Together, when you add them, you have what we call the balance of trade. The balance of trade in goods and services, which is the difference between the receipts from the exports and the expenses from the imports. Really important, if you have more receipts than expenses, so basically if you have exported more than what you have imported, we say that there is a trade surplus, okay? Trade surplus means more export than import, so an inflow, net inflow of money. On the other hand, if the receipts are less than the expenses, so we have exported less than what we have imported, then you have a trade deficit. So you have an overall outflow of money. It's really important that you know these two terms, trade surplus, trade deficit. Then we have income, which we also call net primary income, which is basically all of the incomes that are paid by either a resident to a non-resident, or that are received by a resident from a non-resident. So for example, could be, let's say, because we are in Switzerland, so it could be something like the Collège du Léman hires me, I am a French resident, so it means that from the Swiss balance of payment, this will be recorded as an expense of income, because this is income that is paid by a Swiss resident, the Collège du Léman, to a non-resident, myself. So it will be an expense. But it can also be a receipt. For example, from the perspective of France, this would be a receipt, because a French resident, myself, receives income from a non-resident, the Collège du Léman, so that's an inflow of income from the perspective of France. That's a receipt. It includes, of course, a labor income, but it can also include investment income. If, for example, you receive dividends from a foreign company, if you, let's say I'm Canadian and I have purchased the stocks of an American firm, and therefore I receive some dividends, shares of profits, like fractions of profits, every year from the US, that will be a receipt of income from the US. Could also be that I have purchased some government bonds, and so I receive interest payments from a different country. Well, you see, they are international flows of income. And again, we can calculate the balance, which is basically the difference between the receipts of income from abroad and the expenses of income when we pay people abroad. Then the last one is the current transfers. Current transfers, that's basically transfer payments. So that involves having a resident just sending money to a non-resident, but without receiving anything in exchange. That's the definition of transfer. It's a one-way payment. You don't receive anything in exchange. So this could be the same thing. There are receipts when a country receives a transfer payment from abroad, and there are expenses when we make a transfer payment to another country. Examples include what we call remittance, when, let's say, a Chinese lady, she works in the UK, and so she has a good salary, and she decides to send some of her income to her family that has stayed in China. Well, that would be regarded a current transfer from the UK to China, and so that will be an expense from the perspective of the UK, but this is a receipt from the perspective of China. This can also include some gifts, can include some foreign aid when countries try to support developing countries. And if I remember well, it also involves the payments of countries to international organizations. If you are an EU member, you have to pay some kind of a membership fee. So that's a transfer payment from the government to the EU. It also includes taxes. Like, for example, if you are an American resident, it doesn't really matter, an American citizen, it does not matter where you live in the world. You always have to pay your income tax to the US government, regardless of where you live in the world. And so that would be a transfer payment as well. Okay, so that's what we have. And when we add everything, first we have in each sub-account, we have 4 sub-accounts. And in each sub-account, we can calculate the difference between the receipts and the expenses. And overall, when we add everything, we can calculate the current account balance, CAB. The current account balance, the difference between all receipts and all expenses. If overall we have more receipts than expenses, this means we have a current account surplus. And if we have more expenses than receipts, then we have a current account deficit. Okay. The capital account is usually very small and not very important. So I'm just going to say very few things about that. Well, first we have capital transfers. Just remember one, debt for forgiveness. When someone has a debt and one country decides to cancel the debt, this will be recorded in capital transfer, but that's really not very significant. And you have transactions in non-produced, non-physical. I think it's non-physical. I need to double check. Non-produced, no, non-financial. Sorry, not financial. It's not financial products. Typical examples would be natural resources. Why natural resources? Because natural resources are not produced. So when countries that import natural resources, for example, so rights to natural resources will be recorded over there, like forestry rights, the right to use like the resources inside the forest, could be fishing rights, could be mineral rights, could also be intellectual property, like patents, copyrights, trademarks, all of these intangible assets. This would be recorded there. But basically, very small, not very important account. Yeah, for capital transfers, you can remember like debt forgiveness, and for transaction in non-produced, non-financial products, you can remember rights on natural resources. So the rights, you can trade the right to exploit certain natural resources, and you can also think about like anything that has to do with intellectual property, like copyrights, patents, trademarks. This is going to be recorded there. But again, you'll see in the Swiss BOP, it's very, very small. The financial account, and by the way, again, we have receipts and we have expenses, but I'm not going to enter into the detail, but of course, you can also calculate the capital account balance. Financial account is quite important, and again, we have four main things. First, we have the FDIs. FDIs, the foreign direct investments, which is essentially, so it could go both ways. We can receive foreign direct investments from abroad, which means that people abroad are going to invest into our countries, are going to like buy assets or build assets in our countries. And we can also make FDIs abroad. So people in our country, they are going to buy foreign assets, like foreign factories, for example, foreign companies, or stocks in foreign companies. So it goes both ways. They are the FDIs we receive when people abroad buy our assets, our productive assets, and they are the FDIs abroad when we buy foreign assets. And something that is quite important is that usually when we talk about FDIs, we are mostly talking about substantial investments by businesses, often businesses, who really have an interest in managing a foreign company. So let's say that I am in France and I'm very much interested in a business that is in Singapore. So I buy enough shares from that company. Usually it's more than 10%. That's usually the criterion. So we regard an investment as an FDI, and it's usually a long-term type of investment. I don't just buy the stock because I want to make a financial gain. I want to be active in the management of the organization. I want to be involved in the management, in the decisions, in the design of the strategy of that business. So FDIs, usually substantial investments, more than 10% of the market capitalization of the company. Usually a long-term investment. You have a genuine interest in the company you invest in, and you want to influence the strategy of that business. On the other hand, you also have the FPIs, foreign portfolio investments, which on the other hand, so it's pretty much the same thing. It's often the purchase of stocks or bonds, but without the intention of controlling the company in the case of a stock. Of course, in the case of a bond, you don't, especially government bond, you don't really control the government, so the question is irrelevant. But even when we include like stocks in FPIs, this includes international transactions of stocks that are such that when you buy a stock, you do it for financial gain only. You're not interested in managing the company. Usually your ownership of the company is so small that in any event, you are not like a big shareholder, so there is no way you will be able to influence the company. And then we have what we call the reserve assets, which are assets that are that belong to the central bank. Mostly what we call foreign exchange reserves, which are foreign currencies that are held by the central bank. And as I explained in the video on fixed exchange rate, this is how the central bank can maintain the exchange rate or influence the exchange rate in a managed or fixed exchange rate system by trading foreign exchange reserves. So they are reserves of foreign currencies. And of course, if the central bank buys foreign currencies from abroad or sells foreign currencies to people abroad, this is going to be recorded in the reserve assets sub-account. You may also have gold. The central bank also keep gold, and if they buy gold from abroad, if they sell gold to someone abroad, it's also going to be recorded in that sub-account. And then you have like a residual category that we call other investments. Other investments where just anything else that does not fit in the previous categories. And there is really a little bit of everything. Okay. In this account, unlike the current account and the capital account, where we have receipts and expenses, in this one they've organized things a bit differently, which I think makes sense. Instead of having expenses and receipts, we have increase in assets, or like changes. How did they put that? Like, would it increase in assets and increase in liabilities? That's basically how they've done that. They have like the changes in assets and the changes in liabilities. I'll show you. I'll share my screen in a minute to show like the actual data from the Swiss national from the Swiss balance of payment. So you'll see what I mean. Something that you must understand. Just a sip of Coke. Something that you must understand is that when you add the current account balance plus the capital account balance plus the financial account balance, so basically when you add everything, like all the flows, all of them, in theory, it's always equal to 0 because of something, and I really feel like you should mention it. Something that we call double entry bookkeeping, which is the idea that every transaction, every international transaction is in fact recorded twice in the balance of payment, because every transaction, I'm not going to give you too many details on that. In any event, you will not have time to explain this too much. But basically, to keep it simple, I understand that in every economic transaction, there is an inflow of something and there is an outflow of something. And we record each flow in different accounts. So for example, if Switzerland exports a watch to someone in China, the outflow is the watch and the inflow is money. The watch is a good, so it's going to be recorded in the current account, in the sub-account trade in goods, okay? So the outflow of the watch is going to be recorded in the current account, and it's going to be an outflow, so it's going to be a receipt. So in fact, it's going to be with the sign plus, because it's we receive money basically for that. It's an outflow. We call it a credit, but that doesn't matter. But then we have an inflow, and the inflow is the money. Money is a financial asset, so it's going to be recorded in the financial account. And because it is an inflow, we usually put, by convention, we call that a debit, and we're going to put a sign minus in front of it. Any outflow, to simplify, we're going to put a plus, and any inflow, we're going to put a minus. And so the point, and you can do that for any transaction, any economic transaction is going to be the same. There is an inflow, an outflow, they have the same value, but opposite sign because one goes out and the other goes in. And of course, when you add everything, because you've recorded every transaction twice, one as a positive amount and the other as a negative amount, you find zero. So the balance of payment, and that's why we call that the balance of payment. Because it always balances to zero, at least in theory, is based on the fundamental accounting principle of double entry bookkeeping. But in practice, it's not the case because we make mistakes, because we may forget to record certain transactions, or we may not be able to value the transaction to find the right value of the transaction. Basically, mistakes are made. There are some omissions that can exist. So when you effectively collect the data and you add everything, you find something that is different from zero. So in the BOP, there is an additional term that is sometimes called NEO, for net errors and omissions. It has many different names. Sometimes we call it the balancing item. Sometimes we call it statistical discrepancy. Statistical. It's just an additional value that we add to make the balance of payments balance. Okay. So for example, if when we add everything, just hypothetically, when we add everything, if we find -10, then we're gonna say, oh, okay, so our balancing item is +10. So then when we have the current account balance plus the capital account balance plus the financial account balance plus the net errors and omissions value, we have 0. Okay, so it's just like a statistical tool that we use to make it balance artificially. And in fact, it can be quite big. This amount can be quite big. Okay, so now I'm going to pause the video for a minute for me to get the information about the Swiss BOP. I'm going to share my screen and just to make a few comments about where we are right now in Switzerland. Right, so I found the BOP data for Switzerland since, well, 2013. It's measured in millions of Swiss francs. We're mostly going to focus on 2022. The data for 2023 has not yet been published. Unfortunately, it usually takes some time to put it together. Okay, so let's just analyze what happened basically. So we are first in the current account, so goods and services. So goods here, receipts and expenses. So we see that we have for goods, we have a trade surplus. It's positive. Net means the difference. Okay. So right now, Switzerland has a trade surplus in goods. It exports more than it imports. Services, no, we now have a deficit. See, the difference is negative. We import more services, 153, than what we export, the receipts, which is something that is quite new, as we emphasized before, because if you look at the balance of since the last 10 years, we usually had a surplus in service until like 2016, and this has reversed since 2016. The primary income, we have a deficit, which means that Swiss residents, they pay more income to non-resident than the opposite. So there is a net outflow of income. Could be because of trans-border workers, including myself. Or because a lot of people want to own some Swiss assets from abroad. They want to like Swiss stocks, Swiss bonds, and therefore whenever we pay interest or dividends, there is maybe money flowing out a lot. It's really hard for me to tell you why, because there are many possible explanations. Or you see, you even have like labor income, like I said, like mostly, and yeah, oh, interesting. Yeah, so it's mostly because of labor income. See, there is definitely a net outflow of labor income, so trans-border workers, for example. But for investment income, there is an overall inflow. So we receive more money, more income from abroad than we pay. So the deficit in primary income is mostly caused, my guess, by trans-border workers. Secondary income, the transfers, the current transfers. Negative, meaning which is not very surprising because Switzerland is a very high income country, and usually those current transfers, they usually go mostly from rich countries to less developed countries. So it could be some people working in Switzerland who earn a high income and who send some income back to their family in a less developed country. So that's maybe why we have a deficit. So keep this in mind, quite interesting. And so overall, when we add everything, so when we add this plus the secondary income, that's primary income, plus trading services, plus trading goods, we have this, the current account balance, which is positive. So we have a current account surplus, which basically means that overall, everything taken into account, we have more money coming in than money coming out. So that's the good news. And why do we have that? Because despite having a deficit in the trade, the balance of trading service deficit, a primary income deficit, and a current transfers deficit, we have a very large trading goods surplus. And it is thanks to this trading goods surplus that we overall have a trade surplus. So it's, in fact, it's really good news. And even if you compare to previous years, it's the largest current account surplus that we've had over the last 10 years, right? Look at that. Since 2013, that's great. So it's a pretty good news for the Swiss economy, meaning that more money flowing in than money flowing out in the current account. Now, if we look at the capital account, honestly, I'm not going to say anything because it's just too difficult to analyze. Well, first, you should see that it's very small, okay, compared to the other values. So, for example, trading goods, look at that. Trading goods, we had, so good, okay, so goods and services, we had 106 billion francs, 106 billion francs in as a difference, right? And just the receipts, we had like 600 billion for the receipts, 500 billions for the expenses. Look at what we have for the capital account. Capital account, like the receipts, is just basically 1.5 billion. Expenses, same thing. So that's very, very small. So honestly, I'm not gonna tell anything about that. Just it seems like we have a very small deficit in the capital account, but who cares, honestly. Now, financial account. So you see that's what I told you. It's a bit different. We no longer have receipts and expenses. Now we have like net acquisition of financial assets. So that's basically when people in the, so it's all about buying and selling assets. So when you buy an asset, it goes up, and when you sell an asset, it goes down. Okay, so something positive. So you see here we have negative 779 million francs, which means that we have sold more financial assets than we have bought. Which means that we're gonna have okay, we have sold more than what we have bought, so we may have received more money from the sales of those assets. But basically, what it means is that now Switzerland is overall owning fewer assets, or claiming fewer assets of people abroad. So, well, that's really not necessarily a very good news. Because, yeah, again, it means that we have sold more than what we have bought in assets, so we own fewer financial assets. That's what we do. And here you have net incurrences of liabilities, so same thing. It goes up when we have more liabilities, so more debts, liabilities when you owe something. And when you have less liabilities, it means that it will go down. So maybe when you pay back a debt, it goes down. So let me just explain that again. So this column, like net incurrences of liabilities, will go up. Of course, you won't have to explain that in the exam. I'm just trying to help you make sense out of this table. When it goes up, it means we have more liabilities, so we owe more things. And then when it goes down, it means that we have reimbursed a debt. So it's usually a good sign. So here, the fact that it's negative is actually a good news. It's good because it means that we have reimbursed more debts than new debts we have taken. Basically, if you imagine that it's just about borrowing and paying back, it means we have paid back more than what we have borrowed. So the fact that it's negative here is a pretty good news. But you see that overall, it's positive, which is a good news. But here, in fact, you see that they've taken the difference between this and that. It's a good news. And you see that, but in fact, you should really look at these two separately. This means that, okay, we have sold more assets than what we have bought, so, but just a little, right? Not much. That's a little bad news because it means we now own fewer assets. But this one, which is like the volume is much bigger, you see how big it is. It means that we have really reduced the amount of liabilities that we had. So that's why overall it's positive, which is also a pretty good news for the Swiss economy. If we look into the details, so direct investments, should I really give you those many details? Because then it really gets technical. So overall, it's negative here, which means that we have received more investments than what we have made, which again could be regarded as bad news because it means that now people abroad, they own more Swiss assets than before. That's what it means. Because remember the FDI, they are FDI abroad when we buy stuff abroad, so that makes now we own more assets. And they are also when people abroad, when they purchase our assets. So here the fact that it's negative in terms of FDI is not very good news in the sense that it means that, yeah, sure, we have attracted investment, but it means that now people abroad, they own more of the Swiss productive assets. Here it's positive for portfolio investments, which means that we now, Swiss residents now own more, relatively more financial assets, like portfolio assets than before. Really regarded as a good news. It means that we have purchased more foreign assets than we have sold. That's a good news too. Then we have other investments. I'm not going to say too much about it because there is just too much. Reserve assets here, it's negative, meaning that the central bank has the net, so different between what we acquire and what we sell. So we have sold more than what we have acquired. So the central bank has perhaps sold more foreign currencies or gold than she has purchased. And you see here you have the statistical difference that artificially makes the balance of payments balanced. Okay, my advice. Focus on the current account when you use the data from the Swiss balance of payment. Because whenever it comes to foreign direct investments, foreign portfolio investments and so on, it's a bit tricky. It's really a bit honestly, even for myself, it's a bit difficult to analyze. So focus on the current account. That is the most important for you guys. And it's easier to analyze, right? Receipts, expenses, we understand it. And remember the key elements that I have summarized about the Swiss BOPs, the current account of the Swiss balance of payment. All right, that's all. You know everything about the BOP.